Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome. Today, we're going to tackle a fundamental concept in Canadian taxation: residency. Now, you might think it's simple. It's about where you live, right? But as we're about to see, when it comes to taxes, your physical address is only a small part of a much bigger picture. It's really about a complex web of connections. So let's dive in and unpack what it truly means to be a resident in the eyes of the Canada Revenue Agency. Here's our roadmap for today. We'll start by looking at why residency status is so incredibly important. Then we'll get into the specifics of leaving Canada and the rules around that. We'll also explore the very curious concept of deemed residency, figure out how to solve dual residency conflicts, and finally, we'll touch on how non-residents are taxed in Canada. So, at the very heart of Canadian tax law is this key idea. It's not about location, it's about connection. The CRA uses the term residential ties to describe all the different threads that connect you to Canada. Think about your home, your family, your bank accounts, your driver's license, even something like a club membership. It's the nature and strength of all these threads taken together that determine your tax status. Now, this quote here, this really drives the point home. It completely flips our everyday understanding of what a resident is, doesn't it? Just think about that for a second. You could be considered a Canadian tax resident for an entire year without ever physically being in the country. It sounds a bit strange, I know, but it is absolutely possible, and it highlights just how deep this concept of residential ties really goes. Okay, so what happens when you decide to pack up and leave Canada? Well, it's not quite as simple as just booking a flight. The Canada Revenue Agency, the CRA, is very interested in whether you're leaving permanently or if you're just gone for a little while. And as we'll see, that distinction is absolutely critical. Let's look at a practical example to make this concrete. Meet Jim. He gets a great job offer in Florida. He does what you'd expect. He sells his Canadian house, he cancels his provincial health card. So far, so good. But here's the catch. His partner is still in Canada, and he flies back every single month to visit. So the question is, has Jim really severed his ties with Canada? What do you think? So how does the CRA make this call? Well, they look at a few key factors. First, what was Jim's intent? It looks like he intended to leave permanently for work. But second, look at the frequency of his visits. Flying back monthly, that's a pretty regular and continuous link to Canada, isn't it? And third, they'd ask about his new life abroad. Has he established significant ties in Florida? A new home, new bank accounts, a new social life? The CRA has to weigh all these factors, and it shows that the answer isn't always black and white. Now, for individuals who do manage to make a clean break, they become what's known as a part-year resident. This means that on a specific date during the year, you officially stop being a Canadian resident for tax purposes. Up until that day, you're taxed in Canada on your worldwide income, but for the rest of the year, after that day, you're not. Okay, let's try another one. This is Mark's situation. He moves to LA for a job on February 1st, but his wife and children, a very, very significant residential tie, they don't join him until June 15th. To complicate things even more, their family home in Canada isn't sold until August 1st. So when did Mark's Canadian tax residency actually end? The rule here is actually quite clear. The CRA will use the latest of these key dates. So even though Mark himself left on February 1st, his family didn't leave until June 15th. And because family is such a primary tie, that's the date that matters. For tax purposes, Mark was a Canadian resident right up until June 15th, meaning he pays Canadian tax on all his income from all over the world up to that point. All right, let's move on to one of the most counterintuitive concepts in Canadian tax law, deemed residency. This is a situation where the Tax Act simply deems you to be a resident for the entire year, regardless of your residential ties. You're a resident because the law says you are, plain and simple. And the difference in consequences is huge. As we saw with Mark, a part-year resident has a clear cutoff date. Their Canadian tax obligations on worldwide income end on that date. But a deemed resident? They're on the hook for Canadian tax on their worldwide income for the entire year, from January 1st straight through to December 31st. That, as you can imagine, can have a massive financial impact. So, who gets caught by these deemed residency rules? Well, the most common case involves what's known as the sojourner rule. If you are temporarily in Canada for 183 days or more in a calendar year, that's about half the year, the law deems you to be a resident for that entire year. And it's not just sojourners. This rule also applies to certain Canadians who are serving the country abroad. Think about members of the armed forces, or ambassadors and other government officials. People working for Canadian international development programs are also included. And importantly, so are their dependent children. Okay, let's test that last point. Consider the case of Miss Blakey. Her father is a Canadian diplomat serving in France, which makes him a deemed resident. Miss Blakey is 24 years old. She lives and works in London, and she's actually never even set foot in Canada. So, is she a deemed resident simply because of her father's status? The answer is no, she is not. And this is a perfect illustration of why the details in tax law are so critical. The rule only applies to dependent children who have a very low income. Since Ms. Blakey is 24 and financially independent, her father's deemed residency status does not extend to her. It's a great reminder that you always have to read the fine print. So what happens when you have significant ties to Canada, but also to another country? It's possible for both countries to claim you as a resident under their domestic laws. This is called dual residency, and it's a taxpayer's nightmare because it could lead to being taxed on your entire worldwide income in two different places. Fortunately, there's a solution. That solution is found in tax treaties. Most treaties, like the one between Canada and the US, have a series of tiebreaker rules to resolve these conflicts. You have to apply them in this exact order. First, you look at where the person has a permanent home. If they have one in both, or neither, you move to step 2, their center of vital interests. Where are their personal and economic ties stronger? If it's still a tie, you look at where they habitually live. And only as a last resort, it comes down to citizenship. Okay, let's cover our last topic. What if you've gone through all of this and you are definitively a non-resident of Canada? Does that mean you have no more Canadian tax obligations? Well, not quite. You may still have to pay Canadian tax on certain types of income sourced from Canada. Generally, non-residents are taxed on 3 main types of Canadian source income. First, any employment income you earn from work you physically perform in Canada. Second, income from a business you carry on in Canada. And third, and this is a big one, any capital gains you realize from selling what's called taxable Canadian property. The most common example of this is Canadian real estate. If you sell a Canadian house or cottage, that gain is taxable by Canada, no matter where in the world you live. So, if you remember just one thing from our discussion today, let it be this. Your tax residency status is not something you can just choose. It's not a box you tick on a form. It's a matter of fact, and it's determined by an objective look at the reality of your life and the strength of your connections to Canada. So, I'll leave you with a final thought to consider. Let's say you've done everything right. You sold your house, you moved your family, you think you've severed all your primary ties. But what about the secondary ones? A lingering bank account, a professional membership you keep active, old social connections. Could the CRA weave those remaining threads together to argue that, in fact, you never truly left? It's a question that shows just how nuanced this area of tax law can be.